The S&P 500 just had its largest weekly inflow on record. You've never seen anything like this in your lifetime. It's never happened before. It's a new record. I'm not Fed Jerome Powell, and I'm definitely not Santa Claus. I would argue somewhere in between. So we have some of the answers, and we have what you need to know about our markets here in this video to help you make more money so you don't get cold this year. You get presents and lots of them. Is it time to YOLO your portfolio into call options? Is it time to sit back and see where things settle out? Is it time to casually be buying or to be aggressively buying? Is it time to sell? Maybe sell everything. We're going to talk about that here in this video. Go over everything you need to know. Some impressive new numbers that are out today that are sending stocks even higher. If you can't tell, the work is cut out for us here in this video. That means the work's cut out for you. The first thing you need to do is hit the like button and or subscribe to the channel because it costs you nothing. It's more expensive to breathe oxygen these days than to hit the like button or subscribe to the channel. So let's get started. So let's start here. The S&P 500 just had its largest weekly inflow ever. And by a long shot, the second largest weekly inflow was around the beginning of 2020 when the S&P was doing very well, right before the Rona, when you seen about $11 billion go into the S&P that week. That is right about here. You also seen a pretty aggressive inflow during August of 2020 as well, during the Rona bounce. But now, you're at about $21 billion that went into the S&P just last week. So if anyone tells you they've lived through a market like this before, they have not. I've been in the markets the last 8 years, and I've never seen anything like this. Fortunately, we have seen periods of time kind of like this before, and we do have some historical data that we can go over. Brian Dietrich on X, he runs the Carson Group. He says last week we saw 68% of the components in the S&P 500 make a new 20-day high. This is one of the highest readings ever and suggests extreme buying pressure. Going back the last 50 years, higher 1 year later, 10 out of 18 times this has happened in the past, up 18.1% on average. He says yet another clue, this bull is alive and well. The S&P has been up 7 weeks in a row. On the surface, one might think this is bearish. Not true, as these tend to happen in bull markets. Up 1 year later, 25 out of 29 times this has happened in history, and you are positive 86.2% of the time. This does have a median return of around 8%. Not quite the 50% rally in small caps that Tom Lee's fund strat is vouching for or predicting over the next 12 months, but still 8% is 8%, and imagine if the S&P does 8% next year. Small caps are going to do way better than that. Personally, small caps are where a vast majority of my portfolio is at for 2024. Names like SoFi, names like Fubo, names like even a Palantir for that matter should do okay. Snapchat, Crocs, even CRISPR, I was trying to think of it. CRISPR has had some good news lately. Smaller cap companies. That's where you want to be, your interest rate sensitive names. Even the biggest bear on Wall Street is starting to flip. Mike Wilson, I'm sure you guys remember him if you were an investor in 2022. He predicted basically everything to come to a crashing halt, that stocks could fall as low as 3,000 on the S&P. At that point, that would have been like a 40+% downside. Well, he just said yesterday, technically today, over the past month, we've experienced arguably the best stretch of breadth improvement in 2023. This is an encouraging sign. Small caps likely look compelling given higher probability of accommodative monetary policy. Fundstrat says despite a near 20% rally in the triple Q since late October, the amount of cash on the sidelines now at $5.88 trillion, funds might begin to deploy cash in the new calendar year, which might help to fuel the market rally even more. This is looking at just money market funds alone. This is not including cash in people's brokerage accounts. This is not including 12 months or so of buying of treasury bonds themselves, as rates have been, 5%. Maybe some of that gets locked in for a while. Maybe there's not a rush to sell a bunch of treasuries to invest it back into the markets, but you can make an argument that some treasuries will get sold and cash will be deployed from the sidelines. Money will be pulled out of money market funds, put into stocks. If you add up all of these different pools of money, you're probably at over $20 trillion, if not more, that is waiting on the sidelines that could come back into stocks. And it's not even going to take a big chunk of that to give you a 50+% rally in small cap stocks. The entire market cap of the Russell 2000 is around 2.23 trillion. So even 10% of the money that is presumably in cash on the sidelines coming back into interest rate sensitive names, into small caps, could give you a double or a triple up, not just 50% in small cap stocks. Looks like holiday spending is up big time this year, even as approval of young Biden hits a new low, according to CNBC's economic survey. Intended holiday spending per person jumped 31% to $1,300 this year, yet 66% of Americans are negative about the current state of the economy and the outlook, a record for the 17 years of the survey. As you can see as well from this chart, this is the probability of a recession 12 months ahead. You're currently at 44%. This would be arguably the most predicted recession of all times if it happens. If you've been on Wall Street more than a week, you know the most anticipated outcome usually does not happen. When you consider this and a record high amount of individuals that are not optimistic about the current state of the economy, you could make the argument that we're already so negative, things could actually improve from here. You could also make the argument we've been in a recession for the past 2 years, just government data has not showed us that. I mean, late car payments hit the highest peak ever since 1990 as borrowers shoulder heavy loan rates. This is worse than what you've seen during 08, 09 when unemployment was 10%. How could you possibly look at data like this and say we're not in some form of a recession? Recession or not, the bulls are in full control. According to the latest AI investor sentiment survey, bullish investors near a one-year high at 51.3%, neutral investors at 29.4%, and bearish investors at 19.3%. CNN's Fear and Greed Index is at 79, which, considering the rally we've seen in the markets, I really don't think is all too bad. It is on the high end, sure, but you're seeing record inflows to the S&P. You would think we'd be in way further extreme greed right now. We also see that historically during re-election years, you tend to get a very strong start to the new year, which this is a forecast of what 2024 could look like. You could see a rally from now until March or so, according to this chart, and pull back in really Q2 and then start to accelerate again in Q3 into the end of 2024. We do have some earnings coming out this week. Even today and after hours, you have FedEx. FedEx is seen as very much a bellwether for the state of the economy, so that one's going to be important. You also have General Mills coming out tomorrow, pre-market, Micron and BlackBerry after hours tomorrow, and Nike that will report Thursday after hours. And we're so late into Q4 that these companies are going to have pretty good guidance to give us for Q4. Tomorrow, we will get the inflation rate out of the UK. I doubt that's going to be important or move our markets unless we get a big upwards or downwards surprise. We will get consumer confidence coming out at 10 o'clock in the morning tomorrow. Your bigger data comes out on Thursday with your GDP growth rate final numbers for Q3 expected at 5.2%. You want to see a good economy right now, so the higher, the better. You will get initial jobless claims as well as a lot of small data coming out Thursday. Philly Fed data, Kansas Fed data, initial jobless claims. I said that. PCE final numbers for Q3. A bunch of small data that will come out, or soft data as they call it. Friday is going to be your big day when you're going to get core PCE price index month over month, durable goods orders month over month, personal income month over month, and personal spending month over month. All of these, I'm pretty much in alignment. If you guys want to check out the trading calendar for yourselves, it's a free tool. Just type in trading economics calendar and you'll come to this, and you can see the consensus, the forecast, the actual numbers. As soon as the data comes out, they drop here. I'm pretty much in alignment with this, and I think this could spark an even larger rally coming on Friday. 10-year Treasury yields continue to be on the decline. They are retreating further to 3.93% for your 10-year. That's down 2.5 basis points today, largely fueling the upside that we are seeing to stocks today. Russell 2000 up almost 2%. The NASDAQ, S&P, and the Dow up about the same across the board, about 0.5%. Given all of this bullish information that we have went over, what do I think about stocks right now? Is it time to YOLO everything, to sell everything, to buy casually, to maybe sell a little bit? Well, personally, I think it's up to you, as any good, responsible person making a YouTube video would say. But forget that. I think it's a great time to be buying, personally. But come to your own conclusions and do what you guys want. Not buying the S&P or the triple Qs, not the ETFs or the indexes. I don't think the market-weighted names like Apple or Microsoft are going to outperform next year. It's going to be the year of small caps. And I've shared with you guys the stocks that I like, a Fubo, a SoFi, even DraftKings, a Crocs, PayPal. They're not a small cap, but they're heavily beaten down. I want to own quality beaten down names, preferably small mid cap stocks, but you got to have that element of quality. Now, why I don't like the SPY or the triple Qs over the next couple of days or couple of weeks is because I do expect we're going to trade sideways or slightly down in the next, couple of weeks. Why? Simply put, you're overbought, substantially overbought. Now, I think it's fundamentally justified that we're trading higher at prices we are, but the RSI is at 81 for the SPY. The last time you were here was August of 2020. Before that, it was a long time. I mean, it was back in 2018 when you were this overbought in the RSI. What happens? Every time you come down, or at least trade sideways for some period of time. And I think that's probably going to happen this time around as well. It's not just the SPY. The SPY is the most overbought. The triple Q is at 79 on the RSI. Even IWM is at 70, almost 78. So IWM and your small caps are the least overbought index out there, but still considerably on the overbought side. Am I selling anything? Heck no. Not if it's small or mid cap or interest rate sensitive. No, not selling anything. Is it maybe not a bad time to sell an Apple or a Microsoft trading at all-time highs? Potentially. Potentially that could make some sense because I think there's better areas to put your money to work via small mid-cap stocks. So maybe if you don't have money to buy those smaller mid-cap stocks, it looks clear enough to me in 2024, small and mid-cap stocks are going to way outperform big tech. Unless we go into some deep recession, basically out of nowhere, that's the area that I specifically want to be in. Let me know what you guys think about this information down below in the comment section. Hit the like button and subscribe to the channel if you made it to the end of this video. Let me know what stocks you are buying right now. If you are selling, if you are hedging your portfolios, let me know all of that information. If you are hedging your portfolios, maybe you'd like to know this. Right now is actually the cheapest period of time ever to buy puts on your portfolio. Like seriously, no joke. Right now is the cheapest time to basically ever buy puts on your portfolio besides 2017. 2017 was a little bit cheaper, but right now it's about as cheap as you're going to see it get. Let me know what you guys think down below in the comment section. Hit the like button as well as subscribe to the channel. Like I said, thank you for watching. Enjoy the rest of your day. I will see you in the next one.